Hello friends, in the current video we will work out the problems of ratio analysis. Ratio analysis, right? So long questions of ratio analysis. Here we will be using the questions of T.S. Grewal 12th class question textbook, financial accounting, financial statement and analysis, where the problems of ratio analysis will work out, whereby you can easily understand how to do the long questions of ratio analysis, right? So the first question is question number 135. Opening inventory we have given 80,000. The data we have given in the question, we have given purchases 4,30,000 and direct expenses 4,000. Closing inventory is 1,60,000. Admin expenses 21,100. Selling and distribution expenses 40,000. And revenue from operations, that is net sales, we have given 10 lakhs. Calculate the inventory turnover ratio, gross profit ratio and operating ratio. The required ratios are to be calculated are inventory turnover, gross profit and operating ratio, right? So first one, we need to calculate inventory turnover ratio. Inventory turnover ratio or stock turnover ratio. Anything one and only same, that is inventory and stock one and only same, hence inventory turnover ratio, stock turnover ratio one and only same. So formula for stock turnover ratio or inventory turnover ratio is equals to cost of goods sold divided by average, I have written abbreviation AVG, average inventory or stock, anything, inventory and stock one only same. So what we need to calculate first, average inventory we need to, cost of goods sold we need to calculate, then average inventory, and this ratio will be measured in times, right? So cost of goods sold, first we'll take up COGS. How to calculate COGS? So regarding COGS, what is the, calculation of COGS is based on the information provided in the question, right? So we have given opening inventory, then we have given purchases, then we have given direct expenses, then we have given closing inventory, right? So average cost of goods sold, there are two formulas. One is sales minus GP, right? Or one more formula, opening stock plus purchases plus all direct expenses minus closing stock. So there are two formulas for calculation of COGS, sales minus GP, one formula, then opening stock plus purchases plus all direct expenses minus closing stock, one more formula. Then the question arises, which formula is to be used is based on the information provided in the question. When you see the information in this question, we have the information of opening stock, we have purchases, we have direct expenses, then we have inventory, then closing inventory. Besides this information, we have admin, selling, and this is refers to second formula, and we have sales information even, right? So in this formula, in this question, which formula we can adopt? The second one we can adopt, whereas we don't have gross profit. So we can calculate COGS by applying second formula. So we will apply this formula and calculate COGS. So we have given opening inventory 80,000 plus purchases are 4,30,900 plus direct expenses are 4,000 minus closing stock is comes to 1,60,000. Then calculate the amount. So make the summation, that is 80,000 plus 4,30,900 plus 4,000 plus minus 1,60,000. So we are getting 3,54,900 is our COGS. Right? So once you get the COGS, then what is the next item to be calculated? The next item will be, we need to calculate average inventory. Average inventory formula is, once we calculate COGS, then average inventory. Average inventory is equals to opening inventory plus closing inventory divided by 2. So in this, opening inventory is 80,000 plus closing inventory is 1,60,000 divided by 2. Therefore 80 plus 160 divided by 2 is equals to, how much it will be? 2,40,000 divided by 2 is equals to 1,20,000. Right? 2,40,000 divided by 2 is equals to 1,20,000. Once we get what we call average inventory, then apply the formula and get the answer. So we got two items. One is cost of goods sold, that is 3 lakh, already calculated, 3,54,900 divided by average inventory, that is 1,20,000. That is equals to 2.96 or 95 something you will get, right? So what is the formula? Average, inventory turnover 2.96 times, right? So once we calculated this, we'll proceed to the next calculation. Next ratio what we are asked to calculate then is gross profit ratio. Gross profit ratio. The formula of gross profit ratio is gross profit divided by net sales or revenue from operations into 100. So formula is gross profit by net sales into 100, right? See, while creating the formulas, you must bear in mind that the relevancy you need to check with the item, right? So here profit is associated with sales. That's the reason why gross profit ratio formula is gross profit by net sales or revenue from operation, one and only same, into 100. Here we have calculated COGS inventory turnover ratio in times. Here we are calculating in percentage, right? So if you don't multiply with the 100, the answer will be ratio, that is times. Multiply with 100, you'll get percentage. That's all, nothing else. So first we need to have gross profit. So gross profit, in this question we have not provided gross profit. So while explaining COGS formula, I said sales minus COGS is equals to sales minus GP, right? For GP, what we can do, sales minus COGS will be GP. Therefore its gross profit formula will be sales minus COGS, where COGS stands for cost of goods sold. So in this question, sales we have directly given in the question. So the sales amounts to net sales 10 lakhs we have given. So once you apply the formula, 10 lakhs minus COGS comes to how much? 3,54,900. So then we are getting how much? So deduct it, 10 lakhs minus 3,54,900 is equals to 6,45,100. This is our what we call gross profit, right? So net revenue is directly given in the question, that is 10 lakhs. Then apply the formula. COGS is 45,100 divided by net sales are 10 lakhs into 100, right? So then it will be directly 64.5%, right? So we have calculated our gross profit ratio. Then we are asked to calculate operating ratio. What is the formula of operating ratio? Here I am doing operating ratio is equals to operating cost by net sales into 100. Whereas what is operating cost? Operating cost is equals to COGS plus operating expenses, right? COGS plus operating expenses. So operating cost is equals to COGS plus operating expenses. Here the place is a little bit less, but we were working out. Operating cost is equals to COGS plus operating expenses. So COGS already we have. What is the value of COGS? We have 3,54,900 plus what is operating expenses? Operating expenses here, admin expenses and selling and distribution expenses. These two expenses comes under the operating expenses. So we will take administrative expenses, that is 21,100 it is, plus and distribution expenses is 40,000. So the summation comes to how much? 3,54,100, 3,54,900, sorry, 3,54,900 plus 21,100 plus 40,000. So the expenditure total comes to 4,16,000. This is our operating cost. So apply the formula 4,16,000 divided by net sales are 10 lakhs. Therefore, it comes into 100 multiply, then we'll get the answer in percentage, that is 41.6%. This is our answer, right? So the required question is given, and with this question we have calculated all the three items which are required to be calculated, that is inventory turnover ratio, gross profit ratio, then operating ratio. Clear? So we'll go to the next question, proceed with the next question, right? So question number 136, following information is given about a company. We have given revenue from operations, that is gross revenue from operation, that is net sales, right? Then cost of, so here there is a slight mistake, it seems in printing it has went wrong, it seems so. Actually this is COGS, this is cost of revenue, this is GP, gross profit. Here it is print mistake. Sales is 15 lakhs, GP is 30,000. This is COGS. COGS, cost of goods sold, is 1,20,000. So sales minus 1,20,000 will get 30,000, right? So there is a slight mistake, we have corrected. Opening inventory, closing inventory, then debtors is also given in the question. From the above information, calculate the following ratios: gross profit ratio, inventory turnover ratio, and trade receivable turnover ratio, that is debtors turnover ratio. Right? So how to calculate these ratios? Right. So now we will calculate these ratios from the information we have provided, right? So the information available is very, very important. Based on the information availability, we will proceed with the problem. So first, what we need to calculate in this current problem, we require to calculate gross profit ratio. Right. The first one is gross profit ratio. We'll segregate the paper in two parts, right? So the formula is gross profit by net sales into 100. So in this question we have directly given gross profit, that is 30,000, right, divided by net sales are 1,50,000. So directly information is given, therefore 30,000 divided by 1,50,000 into 100 is equals to 20%. Clear? 20% is our gross profit ratio, directly given. Then second ratio is inventory turnover ratio. Inventory turnover ratio formula is inventory turnover ratio, that is COGS divided by average inventory. Right? COGS is directly given in the question. The COGS comes to how much? 1,20,000 is given in the question. Sales is also available. So 1,20,000 divided by 1 lakh. COG is directly given. Then we need to calculate average inventory. For calculation of average inventory, we have opening inventory and closing inventory. So therefore, average inventory is equals to opening plus closing inventory divided by 2. So opening inventory is 29,000 and closing inventory is 31,000. Divided by 2 is equals to average, will get again 30,000. Now apply this. 30,000 will be the average inventory. So 120 by 30. So we'll get, the answer is 4 times. Right. So first answer is 20%, second answer is 4 times. Then we have trade receivables turnover ratio. So debtors turnover ratio, trade receivable turnover ratio, or debtors turnover ratio, one and only same. The formula is net credit sales. Which sales? Credit sales. Why? When debtors will be created when we sell goods on credit basis. Therefore, net credit sales divided by average debtors or bills receivable. Or we need to make the average. So net credit sales, did we give any kind of a cash sales and credit sales? No. In such a case, net sales itself will be considered as a credit sales. So 1,50,000 net credit sales, 15 lakhs. I'm sorry. So it's 1,50,000 only. Right. 1,50,000 divided by, we have average debtors. So here, in order to calculate average debtors, we need to have opening debtors plus closing debtors plus opening bills receivable plus closing bills receivable divided by 2, not 4, because bills receivable is also part of a debtor. But in this question, we have not provided any information regarding opening debtors and closing debtors is not specifically given. Hence, this debtors is closing debtor, and this 16,000 itself will be considered as an average in the absence of information. Therefore, closing debtors is 16,000. So 1,50,000 divided by 150 divided by 16 is equals to 9.37. So 9.4 we can say. So times. So how many times we are converting our debtors, right? Turnover ratio is, right? So we are converting our sales into debtors 9.4 times, right? This is the answer. In this question directly we have provided the information we are asked to calculate, right? And we'll take up the next question, right? The question number is 137. What the question says: from the following information, calculate any two of the following ratio. Of course, we do all the three, but in the question it is given any two of the following: current ratio, debt equity ratio, then operating ratio. Revenue from operation, net sales is 10 lakhs. COGS, cost of revenue from operation or cost of goods sold, was 80% of sales. In the sense, this 1 lakh into 80% comes to 80,000 will be our COGS. Equity share capital 7 lakhs. General reserve is 30,000. Operating expenses are 10,000. Quick assets, we have given 6 lakhs. 9% debentures 5 lakhs. Closing inventory 50,000. Prepaid expenses 10,000 and current liabilities 40,000. Wow. More information is provided in the question, right? First, current ratio. We are asked to calculate. So first we'll take up the current ratio. Right? So the formula of current ratio, as you are already aware. What is the formula of current ratio? Current ratio. Formula is current assets divided by current liabilities is the formula. What is the formula? Current assets by current liabilities. What do you mean by current asset? Current asset, as you are already aware, any asset which can be converted into cash within a span of 1 year is called as current assets, right? What do you mean by current liability? Any liability which is payable or due for payment within a span of 1 year, within a span of one accounting year, is called as current liability, right? So the combination of current assets and current liabilities, because the current assets, out of the proceeds and amount generated from the current assets, we will make the payment of current liabilities. So these are what we call very important assets and liabilities for the business, because these are operating assets and operating liabilities, we can say, right? So then we will proceed with the question. We require to have current assets and current liabilities, right? So here equity share capital, general reserve, operating expenses, quick assets is given, and debentures, closing inventory, prepaid expenses, and current liabilities. What is the formula of quick asset? We need to understand. Quick asset, assets. Quick assets is equals to, always bear in mind, current asset minus stock plus prepaid expenses. In the sense, what? All the current asset but excluding stock and prepaid expenses will become our quick assets. The reason is, the stock cannot be converted into cash within a less span of time, and expenses prepaid, which is already prepaid, right? That's the reason why these two items will not come under the category of prepaid expense, quick assets. Hence these are excluded. So in this question we have given prepaid expenses. How much? Sorry, in this question we have given quick assets 6 lakhs. In the sense, current assets minus these two items, we got quick assets. Quick assets are 6 lakhs. Then we have given stock 50,000 and prepaid expenses 10,000. In the sense, what? In order to calculate current assets, this quick assets plus inventory and prepaid expenses will get current assets. Therefore, CA is equals to QA plus stock plus prepaid expenses. So like this we can create the formula, right? So quick assets are 6 lakhs given in the question, plus inventory is 50, prepaid is 10. 50,000 plus 10,000, right? That is equals to 6 lakhs 60,000. So this is what our current assets. So 6 lakhs 60,000 are our current assets, divided by current liabilities directly given in the question, that is 4 lakhs. is equals to, so 660 divided by 4 lakhs is equals to 1.65 times, or 1.65 is to 1 also we can write. So current ratio is 1.65 is to 1. Then what we have asked to calculate, debt equity ratio. This is a very very important ratio, debt equity ratio. What is the formula of debt equity ratio? Debt equity ratio is equals to long term debts divided by shareholders fund. The formula of debt equity ratio is long term debts divided by shareholders fund. I'll write here, right? Debt equity ratio. The formula of debt equity ratio is long term debts divided by shareholders fund, right? Then how to calculate long term debts? What do you mean by long term debts? Long term debts is refers to any liability which is payable in beyond 1 year, after 1 year, or in a more than 1 year period is called as long term debts. Exclusively long term debts would be considered as a debentures or any long term liability, right? So in this question we have long term debts are 9% debentures is our long term debt, right? So this 9% debenture considered as a long term debt. So we have long term debts are 5 lakhs. So long term debts are, yeah, like 5 lakhs. Then I need to have shareholders fund, SHF. I have written abbreviation. What is this shareholders fund? Amount belongs to shareholders. Shareholders fund comprising of what? Shareholders fund consists of equity share capital plus preference share capital plus reserves and surplus or general reserve, P&L account, credit balance, right? All those comes under this category of shareholders fund, right? So shareholders fund, equity share capital, preferential capital plus reserves and surplus, right? So apply the formula in this question. What we have: revenue from operation, cost of revenue, equity share capital 7 lakhs, general reserve 30,000, right? So 7 lakh plus 30,000 will be our 10 lakhs. So therefore 7 lakhs plus, sorry, 3 lakhs reserve is equals to 10 lakhs. 10 lakhs is our shareholders fund. So 5 lakhs divided by 10 lakhs is equals to 0.5 is to 1 will be our ratio. In the sense, what we are trying to explain in this, right? Our long term debts are 50% when compared to our shareholders fund, that we are trying to explain. So debt equity ratio is equals to long term debts by shareholders fund. Clear? Then next is what? Operating ratio. What is the formula of operating ratio? Already we have done in the earlier problem. Operating ratio is equals to operating cost by net sales into 100. Formula of operating cost is equals to COGS plus operating expenses. Under this operating expenses, admin and office, selling and distribution expenses will come. These two collectively called as operating expenses. So understand. So COGS div plus operating expenses is equals to operating cost. Then net sales will be the net sales item. So we need to have COGS. So did he give any COGS directly? 80% of the sales. So 1 lakh into 80%, that will be 80,000 will be our COGS, right? Plus operating expenses. Directly he has given operating expenses. So this 80,000 plus operating expense 10,000, that is 90,000, right? So operating cost is 80,000 plus 10,000, right, is equals to 90,000. Clear? Then we need to have net sales. Net sales is directly given in the question is 10 lakhs. Then here the place is not sufficient. Don't leave the place here. So we'll directly do it here. So the application of the formula is operating cost is equals to 90,000 divided by sales are 10 lakhs, right, into 100, that is equals to, sorry, sales are not 10 lakhs, it is 1 lakh. So very careful with the numerical values, right? So then it will be 90%. This is our operating ratio. Suppose if operating profit ratio, so suppose the question asks you what is operating profit ratio? Operating profit ratio. There are two formulas. One is operating profit by net sales into 100. In this question, we have not asked this operating profit ratio, but still I am explaining to make you understand. Operating profit ratio is equals to operating profit by net sales into 100, right? Or one more formula we can apply, that is 1 minus operating ratio, or 100 minus if it is, right? 1 minus operating ratio. Clear? So in this question, 100 minus operate 100 or 1. If it is percentage, we'll take 100. If it is ratio, we'll take 1. So 100 minus 90 is equals to 10 will percentage will be our operating profit ratio. Clear? Our operating ratio is equals to, one more formula is 100 minus operating profit ratio. Like that we can calculate, right? So I hope I made you understand this concept. So one more question we will take up, right? Then question number 138. On the following information, calculate the inventory turnover ratio, operating ratio, and working capital turnover ratio. Right, operating inventory turnover, operating ratio, and working capital turnover ratio. Right, opening inventory is 28,000, closing inventory 22,000, purchases we have given, revenue from operations and returns we have given, right, that is sales return, carriage inwards we have given, office expenses, selling and distribution expenses, and then working capital is 40,000. First one is what we need to calculate, inventory turnover ratio. What is the formula of inventory turnover ratio? Inventory turnover ratio. Right. Formula of inventory turnover ratio is ITR. COGS divided by average inventory. Right. COGS. First calculation of COGS. How to calculate COGS? As we have already discussed COGS calculation, we have two formulae. One is sales minus GP. Sales minus GP, sorry. Or one another formula, opening inventory or opening stock plus purchases plus all direct expenses minus closing stock, right? So in this question we can apply the first formula, that is opening stock plus purchases and direct expenses is carriage inward, right? Minus closing stock. Apply this formula. Opening stock is how much? 28,000. Purchases are 46,000. Plus direct expenses is carriage inward. I am taking 4,000. Minus closing stock is 22,000. Then apply it. 28,000 plus 46,000 plus 4,000 minus 22,000, that is equals to 56,000 is my COGS I am getting. How much I am getting? 56,000 is our, sorry, COGS. So COGS 56,000. Then once we got COGS, we need to have average inventory. Average inventory is equals to opening plus closing divided by 2. So opening inventory is 28,000, closing inventory is 22,000 divided by 2. So it will be 60 by 2, that is 28 plus 22, 50 by 2 divided by 2 is equals to 25,000. Then it will be 25,000, right? So 25,000 is our average inventory. Then apply the formula. COGS by average inventory. COGS we have calculated just now, 56,000 divided by 25,000 is equals to, so 56 divided by 25 is equals to 2.24 is our answer. 2.24 is our answer, right? So in the same way, we'll calculate the other ratios here. So we have done with this inventory turnover. Then operating ratio. Already you are aware, operating ratio is equals to operating cost divided by net sales into 100. So operating cost is equals to COGS plus operating expenses. So COGS already we have calculated just now. How much it was? 56,000 we calculated. So COGS is 56,000 plus operating expenses. In this question, operating expenses, what we have given? Several returns, carriage inwards, office expenses and selling expenses. 4,000 plus 2,000. So 4,000 plus 2,000, that is equals to 6,000. 62,000 is your operating cost. So 62,000 divided by net sales are directly given in the question, that is 80,000 into 100. Therefore 62 divided by 80 into 100 is equals to 77.5%. 77.5%, right? This is the second question answer.